Good morning. Welcome to Fix It Finance. We are coming to you live. It's Saturday. It is 12 p.m. Eastern. I'm still getting used to saying this 12 p.m. Eastern thing. Okay. So if you're joining us, if you're new here, my name is Fikayo. I go live every Saturday at 12 p.m. Eastern, and I teach you on all things personal finance. Um, I today we're talking about ETFs, so it's going to be very exciting. We were supposed to talk about this last week, but the Bank of Canada decided to cut interest rates, so we instead focused on that. And yeah, welcome, welcome, welcome. So if you're new here, my name is Fikayo. This channel is called Fix It Finance. I hope you take control of your money, build the life you want. Remember to like, share, and subscribe. Don't forget to let people know that this is going on. If you have questions as we go through today's topic, make sure you put it in the comment section. Um, don't forget to hit the notification bell so you know when we have new videos. I'm doing my best to go. We've been going live every Saturday since March, and we've been consistent, so we thank God for that. So yes, live every Saturday, 12 p.m. Eastern. Um, Today we're talking about exchange traded funds, or ETFs for short. We'll start by taking a deep dive into what they are, some of its best features, and then we'll talk about some of how to invest in it, and then of course exactly what to do step by step, how to invest in it, and then some ETFs to actually check out, to look at if you're considering investing in ETFs. So welcome. Make sure you tell somebody this is going on, and we will get started right away. Ha, thank you. Nice outfit indeed. I figured some of these things I'm not going to wear them out anyway, so might as well just rock it. I was not going to wear this morning, and then my husband insisted, but here we are. Okay, thank you by the way for the compliment. Okay, let us get started. What are ETFs? So ETFs are called exchange traded funds. They are a great way. Thank you. On Instagram, someone is saying I look good. I thank you very much. So ETFs are exchange traded funds. Um, ETFs for short. So I'm going to be referring to it throughout this process as ETFs. So just exchange traded funds, but ETFs for short. Okay. So what are they? The exchange traded funds, they basically combine the benefit of a stock, right? Which trades actively throughout a market day, right? So you know how with stocks you can buy a stock so long as the market is open, you can buy shares in Apple, Facebook, whoever else, or Meta, not Facebook, whoever else you want to buy throughout the day, right? And it also combines the benefits of a mutual fund, which is a fund that invests in different companies, at the same time. Okay, so imagine bringing um um the two best features of those two products. So you can trade stocks anytime throughout the day. And mutual funds, you get to invest in different companies at the same time and putting those two together. That's how you get exchange traded funds. Okay. So they come together blending those two qualities. So the benefit of a stock which can trade actively throughout the day, and a mutual fund which invests in multiple companies. Okay. So a brief history. ETFs were actually created as an alternative to mutual funds. Okay. So mutual funds started as you know, back in I think 1970 something. I don't know. There's this is not a history lesson, but just for a brief history, um index funds, for example, started in 1976. John Bogle, he's the founder of Vanguard, which is, a massive ETF provider. We'll talk about that later on. So, index investing started then. And then as people started doing these types of investing, there was also, already mutual funds whereby a group of people come together, put money together, and of course, buy these different shares of companies. So as index investing and mutual funds and stock investing, all these things evolved naturally. The ETF came to be. Okay, so which is blending the best of all these features, you understand, and putting them together and calling it what we call exchange traded funds. Okay, now I really like ETFs, and you'll see why in the next few minutes. So let's talk about um a few other things. So like I mentioned, they were created as an alternative to mutual funds. They didn't start trading until 1993. So actually ETFs are quite new technically. Well, not depending on how you look at history and whatnot. They're about 20 years, 21 years old right now in terms of when they actively started trading. So it's still pretty fresh. Okay. So, but at least we have enough history in there to be able to say, okay, is this something that's good to invest in or not? Okay. We have roughly 20 years. So if you're looking at any ETF, for example, you definitely want to be looking at, historical performance, potential future performance, and of course, what the thing is actually doing and investing in today. We'll get into that as we continue our deep dive. Okay, let's go into the features of ETFs. So we've talked about what they are. We understand what they are. If you have any questions, put them in the comments and don't forget to share this and let people know that we are live. Okay. Um, Diversification. This has to be hands down the number one benefit or the biggest advantage that ETFs provide to an investor. Okay, it provides you the ability to be diversified. So rather than take on the risk of investing in, say, Meta directly or Tesla directly or excuse me, ExxonMobil directly, you can say, okay, I don't want to expose myself to the fluctuations that ExxonMobil or Meta or whoever may have each and every day. So let me put my money in something like this, that invests in multiple companies at the same time. So that way, if one is not doing well, that scripture that talks about cast your bread upon many waters, for you do not know which one will do well, whether this or that. There's another, I might be mixing the two of them, but there's another scripture that talks about um um put portions to 7, yes to 8, for you don't know which one will do well. You understand? So ETFs basically take this principle and just magnifies it in the sense of you can invest in an ETF that invests in, say, 300, 400 or more companies. You understand? And that way, even if one fails, the others will lift it up. You understand? So you know for a fact that you're not necessarily, again, depending on market conditions, you're not necessarily going to be going down if this particular company goes down. Okay. It's like I hate to make this joke, but it's kind of funny. During COVID, I really liked what Peloton was doing. I was like, this thing is really, really good. But when I did my analysis, it was just so overvalued. It was trading at over 100 and something dollars at that time. And I just couldn't bring myself to buy it. And as of last I checked, I don't even know what Peloton is trading today. If you know what it's trading for right now, please let me know. But the last I checked, I think it was like less than $10 a share. You understand? So imagine if I had carried my full chest and put, it would have paid me. But again, this is what I'm talking about in terms of diversification. So ETFs let you diversify your investments. Okay. With ETF, you own a little bit of the different companies that are inside that ETF. Okay, you spread your risk. You also spread your reward because, for example, if I invested, let's say I invested in, I don't know, GameStop today, it was $5 and now it is now $50. You understand? I would have taken all that reward, but I also bear all the risk if it goes from $50 to 5. You understand? So you spread the risk, but you also you spread the reward. You understand? So you may not make as much as the person who, say, invested directly into the company. That said, you also don't lose when the person loses their shirt. Okay. So rather than invest in, individual stocks and take on all that risk, of course, the risk and the reward, like I just mentioned, you can invest in multiple companies at once and spread your exposure, to market fluctuations, the company potentially going out of business, the company becoming bankrupt, the company becoming delisted for whatever reason. We find out that the president was traveling to God knows where, doing God knows what, and that affects the stock. There's so many different things that could happen, but you kind of you steady the boat, for lack of a better word, when you invest in something like this, so you don't get as much direct hits. Okay. um and the reason for this is when it comes to buying stocks, because I know a lot of people are always like, you can make more money if you buy directly, or you can, if you know what you're doing in the stock market, blah, blah, blah. And I agree. I completely agree. You definitely can make more money if you know what you're doing and you can invest directly in the stock. However, for most people, the average person, even me, that I'm a finance person and I have finance background and I'm into all these things, it takes time to be able to do your research, understand the company, understand its moat, understand, its business, understand its core business, understand, what it does, you understand? And at the same time, knowing when to enter. But the biggest thing most people don't know, knowing when to enter is easy. It's knowing when to exit that is the hard part. You understand? Knowing when to enter is very easy. You can do all your research, understand, blah, 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 blah. Knowing when to exit, that is where, you understand, because you don't know when it's going to go down or when it's, you understand? So anyways, investing in an ETF and whatnot helps with some of these things. Okay. So the next feature we're going to talk about. So we've discussed diversification. let's talk about types of ETFs. So there are different types of ETFs. When ETFs first started, they focused mainly on index investing. Like I mentioned, it was something that started and it evolved, you understand, from index investing and mutual funds and whatnot, and they came together, and this was birthed from some of those innovations in financial just in the financial industry in general. So today's world, though, ETFs are very, very much, there's pretty much an ETF for anything you're looking to invest in. Okay. If you want to invest in stocks or equities, there's an ETF for that. You want to invest in bonds, there's an ETF for that. You want to invest in only Canadian stocks, there's an ETF for that. You want to invest in halal stocks, there's an ETF for that. You only want to invest in, disruptive technology, Bitcoin, and all these other things that are shaking and moving the market every day, there's an ETF for that. You only want to invest in real estate, there's an ETF for that. You understand? So there's an ETF for pretty much every sector and every type of investing that you're looking to do. So the major types is equity ETF. For example, an equity ETF invests in stocks, and it tracks various markets. So you can have one that invests in, say, the Canadian market or the US market, or a combination of the two, international markets like Japan and the UK, the EU, and whatnot. You can also have ETFs that are sector specific. So if you want to have ETFs, for example, that only invest in tech, or only invest in banking, or only invest in energy, you understand? So there are ETFs across all broad lines for that. There are bond ETFs as well. So you have ETFs that invest in, say, the government of Canada bonds, US Treasury bonds, corporate bonds, provincial bonds. So you have an ETF for basically, excuse me, every single one of those types. You also have ETFs that are commodity ETFs. So, for example, you want to invest in gold, you want to invest in natural gas, you want to invest in agriculture. There are Bitcoin ETFs right now. Bitcoin is considered a commodity, depending on your what definition you're using. And of course, they have index ETFs, so things that track things like the Nasdaq, S&P, the Toronto Stock Exchange, and stuff like that. So they aim to replicate the performance of an index. Okay, so that's one of the other features or benefits that an ETF has. We've talked about diversification, and now we're talking about just the variety of ETFs. There's an ETF for everything. You understand? Every single type of investing. You only want to invest in female-led companies. There are even ETFs that are doing that now. Okay, or black-owned companies. There are ETFs that are doing that now. Okay, excuse me. So you really get to determine the type of investor you want to be using ETFs. Okay. Another feature that we're going to talk about is liquidity. Again, when you look at the history and how it evolved, or how it began as a type of investment, one of the major benefits of ETFs is its liquidity. So, for example, if you buy an ETF today, let's say you buy anyone, VFP, for example, let's say it's trading for $130. Okay, or if you want to sell it, you just sell it right away for $130. The same way you can sell a stock or a bond right away on excuse me, on the stock exchange that you're using, or through the broker that you're using. Same way, you get access to your money right away, so you don't have to like wait for a long period of time to be able to access your funds. So let's say you have money in an RRSP and you're invested in ETFs. You want to check out your money today, you just sell it, and within however many days your broker provides, you get your cash. Okay, so it's very liquid, which is also really nice. Okay, they trade throughout the day, so you're able to buy and sell as you need, or as you see fit. Okay, you can get your money out easily, which is a very, very good feature of this type of investment. Fees. Okay. One of the other features of ETFs that are really, really good, they have some of the lowest fees, or expense ratios, as they are called in the finance world, than any other type of investment. So, for example, a mutual fund could charge you upwards of 2%, or an actively managed fund, for example, let's say through Canada Life, TD, whoever, they may charge you upwards of 2% as the management expense ratio. Sorry. An ETF, on the other hand, may charge you maybe 0.03%. You understand? On the same type of investments invested in the same type of companies. Okay. So it may not seem like much, but it's actually a massive difference. Okay. And if we have some time, just looking at time, I don't think we would, but if we did, maybe I might do a part two where we'll go into some calculations and some examples. Okay. So there are two types of fees to note when it comes to ETFs. The first one is the management expense ratio, like I just mentioned. It's charged by the ETF provider. So if it's a Vanguard ETF or a BMO ETF or BlackRock iShares ETF, they would be the ones to charge that expense ratio, that fee. Some of them are at 0.03%, some 0.035, some 0.08. It's very, very small compared to what you would be paying if you were in an actively managed fund. Um, the other type of fee you would likely pay when you're investing in ETFs is something called a trading fee. So, for example, let's say you were going through a robo advisor or an online brokerage like, say, Questrade or Wealthsimple. They may charge you a fee. Most of them let you buy ETFs for free to a large extent. I'm yet to run into one, or I haven't used one yet that would charge me to buy an ETF, but most of them will charge you like a commission when you want to sell. Okay, so like a commission fee. So like I believe it's Questrade. I think it's $4.95 as a commission fee on any trade you make when you want to sell. Okay, so they all have their different prices, but those are the two types of fees you run into when you're dealing with ETFs. So it's important to understand that, and it's also important because you don't want fees eating into your returns in general. So that leads us to our next thing. Let's talk about returns, ETFs, and the types of returns to expect on ETFs. So the type of returns you can expect on an ETF is usually in two categories. First one is dividends. So for the most part, if the underlying asset in an ETF pay dividends, then a portion of that is distributed to you that you own the ETF. Okay, so some already have predetermined um um dividend number. So you might say, okay, 1.5% per quarter or whatnot, or per year is paid as a dividend. Okay, so you need to understand this when you're actually reviewing or researching your ETF. Understand what that looks like. The other type of returns you would get, and which is also the biggest type of return you would get, is something called capital gains. If you remember our video when we were talking about budget 2024, we talked about the new capital gains tax and all that jazz. So if you really want to understand capital gains, we did a deep dive in that video. So check that out. But capital gains is the next type of return you will get when you're dealing with ETFs. So as the value of the underlying companies grow, okay, the value of the ETF also grows. Okay, so if, for example, Meta has like beyond imaginable profits and whatnot and grows, likely if you have an ETF that's also invested in Meta, that ETF is also going to grow. It's also going to balloon as that happens. The opposite is also true. So for example, if there are negative market conditions, all the companies are crashing left, right, chances are that ETF is also going to squeeze and reduce in value as well. Okay, it all depends on the value of the underlying assets. And when I say assets, I mean the companies or the commodities or bonds, whatever it is invested in. Okay, on most ETFs, the returns you get, so like the dividends and whatnot that are paid, are automatically reinvested to the most part. So if you're getting payouts on your units and whatnot, you may want to check that just to make sure that you are making sure it's getting reinvested. Okay, so this one I always talk about when I'm dealing with anything investing, just because my accounting background. Taxation, yay, who doesn't love taxes? So if you know, so last month we did an entire series where we talked about, so each Saturday I basically took a registered account and I did a deep dive on each one. So we talked about TFSAs, RESPs, RRSPs, and FHSAs. So you can go back and watch those videos. They're all 30 minutes or less. So those accounts, if you buy an ETF, so if you remember in each of those videos, at the end when we went into how you can invest into each of those registered accounts, we talked about those accounts, although they are not investments in and of themselves, they can hold investments. So this month we've been talking about the type of investment that those accounts can hold. So for example, we did GICs I think 2 weeks ago. Today we're talking about ETFs. So in that registered account, you can hold ETFs inside that account. So think of the account, like I mentioned, as a basket. This is one of the things you can put inside. So if you are putting apples, oranges, bananas, this is something you can put inside that basket. Okay, so if you hold ETFs in a registered account, the tax treatment of that registered account is what gets applied to the ETF. Okay. So if you own ETFs in a TFSA, for example, the dividends, the capital gains, no tax. Okay, because you own it in a TFSA and it's called a tax-free savings account, so you don't have to pay tax on that. If you own the ETF in, say, an RRSP, same thing. You don't pay tax now, but when you withdraw in the future, you pay taxes on it. If you own it in an FHSA, Remember, we talked about FHSA combines the benefit of the TFSA and RSP, so you don't pay any tax on your contribution and on the growth as well. So it takes on what it adapts to. The tax treatment adapts to whatever account you buy it in. Okay. If on the other hand you're holding it in a non-registered account, then the taxation rules change. So you will be taxed on the dividends, for example, and when you go to sell, you pay capital gains tax on that sale. Again, depending on where you hold it in. If you hold it in a corporation, it's going to take on what the corporation tax laws take on. If you own it individually, it's going to take on individual taxation laws. Okay, so be cognizant of that in terms of when you're choosing when to buy it, how to buy it, where to buy it, in what containers. Okay. US withholding tax. So this is just an important aspect. So this comes up a lot, and I noticed some people, especially when I talk to some folks, because of US withholding tax, sometimes they dismiss ETFs as a potential investment. So don't do that. Let me break it down. So for the most part, if you're buying ETFs with underlying US assets, right, you may be subject to something called a withholding tax or non-resident withholding tax. So it's basically the US saying, okay, you don't live here, you are a non-resident. We want to make sure we take our cut. If in fact, you're supposed to pay tax. Excuse me. If it's in an RRSP, so if you buy, for example, any of these ETFs in an US-based ETFs in an RRSP, there's no withholding tax, and that's because the tax treaty that the US and Canada has covers investments that are done in an RRSP because they know it's an investment account, for retirement and whatnot. I've said this in the past videos. I still don't know why they have not added, things like the TFSA, the FHSA. Again, the TFSA is fairly new. It came out in 2009. You understand? So it's still fairly new, but it's been more than enough time. By now, they ought to recognize it fully, and maybe they have. I just don't know, but I still haven't heard that they have. So accounts other than RRSPs. Okay, if you buy an ETF in those accounts, you will be subject to a 15% withholding tax. Now, before you think that's a bad thing, what happens is, for example, the 15% withholding tax is not on the entire investment. It's on the income that's received on that. So the dividends that are paid. Okay. So for example, let's say you have an ETF that pays out dividends at say 1.5%. So let's say the total assets you hold in that account is 40,000. 1.5% of 40,000 is $600. Okay. What you're doing is you're going to pay tax of 15% on the $600. So not on the entire thing, not on the entire 40,000. So it's not like they're going to look at your assets and say, okay, you have this much in assets, come and pay tax on it. No. So they're charging you based, for example, whatever dividends you receive, it's subject to a withholding tax. So you want to understand that. So for example, I usually tell people not to worry about it until your portfolio hits that, 6-figure or more. So once you start to enter the 250K and above mark, maybe you want to work on it. Because for example, if your assets in total are say 40,000, $600 is what you're getting in dividends. You're only paying 15% of that, which is $90. $90 is not enough to not take advantage, you understand, of what ETFs provide. Okay. Now, if your account was say $100,000, then you're paying closer to what, 300, 500, I don't know. You understand? But basically, it doesn't really start to make a massive difference until you start to hit certain thresholds when it comes to your investing. So I wouldn't worry about it too much until you get there. Okay. Let's talk about price, which is another feature. So, excuse me. The price of an ETF is determined based on the value of the underlying assets, like we mentioned. So, one thing to be cognizant of is it can be affected by market conditions, just like any other investment, like the stock, bonds, whatever. If underlying market conditions like economic factors, for example, let's say unemployment rate starts to climb, the rate of inflation, basic demand and supply. If there's high demand for a particular ETF, for example, versus so you want to it also gets moved by the market conditions. So when we talked about GICs, remember how the government guarantees, not the government. So like there is something called the CDIC, so Canadian Deposit Insurance Corporation. So they guarantee GICs, for example. This is out of that realm. Okay, so this doesn't fall under what the government guaranteed. That's because this moves just like the market moves. Okay, so they can't necessarily guarantee those funds. You understand? So you are still subject to market conditions, even if you're investing in ETFs. So it's important to note that. Okay. The price goes up and down throughout the day, like I mentioned earlier. But one of the things that's really good about it is there's no minimum, except, for example, the cost at the time of purchase. Excuse me, I'm recovering from a cold, so I apologize. Um, if, for example, you're investing in the mutual funds, right? Some of them have like barriers to entry, like, okay, you have to invest $1,000 or you have to invest $10,000 to get started in that fund. Most ETFs, so long as you have the price of the ticker at the time. So if it's $25 per unit, if you have $25, you're ready to start investing. If you have 100, let's say it's $100 per unit. If you have $100, you can buy one unit and sit there. I have some ETFs whereby I only have one, and it's just because I just wanted to check it out. Okay, so feel free to get started. There's no quote unquote minimum requirement per se. Okay, especially when it comes to the price. So let's go into the crux of the matter, how to actually invest in ETFs. It's very straightforward. Again, if you've been watching our videos and you've been joining us live, you already know this process to a large extent. So number one is you open an account, a brokerage account through your bank, through a robo advisor, Q-Trade, Questrade, well, simple. There are so many of them. Through your financial advisor, for example, if that's how you choose to deal, and that's okay. Number two, you process any necessary paperwork. So a lot of times if you're doing it online, they would have different things that they make you sign. You get all that signed. Most of them use DocuSign. Well, not DocuSign, but a version of DocuSign. You get that signed and going. The next step is you assign, always, 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 and I say this all the time, and I think I made a post this week. Please don't let this be you. Assign a beneficiary as you are opening the account. Don't say I will do it next week or I will do it next year. Assign a beneficiary or successor holder as you're opening the account and update it as necessary. Okay. I read a story and I shared it last week of some guy who his ex-girlfriend, not even ex-wife, ex-girlfriend of like almost 30 or 40 years ago, he put her down in his on his pension plan as the beneficiary. And she, now that the guy has passed away, she's coming to claim it, and his brothers are trying to block her from claiming it. And in my mind, I was like, you can block from now to next year. Chances that she's gonna get that money because she was the beneficiary on the account. So don't be like that. Update your beneficiaries, but assign one as you open an account as well, so you don't make that mistake, okay, of just leaving it open. Beneficiary or successor holder, depending on the account. We've talked about this in previous videos, so make sure to refer to that. Number four, fund the account. Actually put money in the account so you can use that money to buy what you need to buy. Number five, do your research, okay. Part of doing research involves, understanding your own personal investment strategy, like what are you trying to do. Someone like me, I like passive, very lazy investing. I don't like to stress. Upon all my degree and everything, I like keeping it very simple. So, I like to choose ETFs that are index based, that are focused on indexes, because we know, you know just based on past performance, and just if you compare all the people that are going up and down, rocking boats and doing everything, at the end of the day, their performance versus what the indexes are doing is either the same or the index is better. So you understand? That's why I like passive, lazy, just keeping it simple, low key, straight to the point. I don't have to worry about it. Okay. Number six. So do your research. Make sure you understand the types of ETFs you want to invest in, and then put your money in it. Number six is to actually purchase the ETF. Okay, once you've done your research, you've assigned your beneficiary, you know exactly what you're doing. Buy one or two just to kind of see how the things move. If you want to play around with it, just to get your feet wet, you understand. But when you're ready, buy. There are two ways to buy. First one is something called a market order. So a market order, you'll be able to buy it at whatever price that the broker has set. Not the broker, whatever price it is at that time. Okay. So for example, if it's currently trading at $115, once you put your money in, it's going to buy units at $115. If between the time you click buy and the time the broker processes it, the price changes, whatever price they lock it in, that's the price they're going to pay for at the time you buy. So that's called market order. Limit order, for example, you set the price. So for example, let's say an ETF I'm looking at is currently trading at $115 and I want to sell. I may say, okay, sell it when it hits $117. So I set the price, and it's both ways for buying and selling. Okay, so market order, whatever price it is at that time, that's what it sells for, or what you buy it for. Limit order, you set the price. So for example, I think I purchased one unit of was it VXC or something 2 days ago or 3 days ago, and it was trading at like $58 and something cents. So I put, okay, when it hits $57 and this cent, buy it. And that's exactly what my broker did. And I noticed it bought it at the price I set. Okay, so make sure you understand those two types of purchases. Now, is one better than the other? Not necessarily. It all depends on what you're doing at the time you're doing it. Okay. So now that we talked about how to actually buy it, let's look at some of the uh top providers in Canada. Well, not just in Canada, and the world in general, when it comes to ETFs. So you have BlackRock, iShares. So when you hear these names a lot when you're talking about ETFs, BlackRock, iShares, Vanguard for sure, BMO, Horizon, Purpose Investments, TD Asset Management, RBC Global Management. Most banks, most credit unions, you understand, so long as they have some sort of asset management arm of their business, they will sell ETFs. But for sure, the non-bank ones include BlackRock, iShares, Vanguard for sure. Those two are definitely some of the biggest ones in the marketplace today. Very important note. If you take nothing else from this, make sure you remember this, okay? Because of how ETFs are and how diversified they are and just how unique they are in the financial space, if you're investing in ETFs, be very careful that you're not investing in the same thing over and over again. So, for example, if you're going to buy ETFs from, say, Vanguard, okay, and you want to go and buy another one at BMO, just make sure you are understanding the underlying assets inside. So you're not buying the same thing from BMO. And again, if that's your strategy, that's okay. Okay, so for example, I mentioned how I do some just lazy index investing. So if I have a ETF that's tracking, say, the S&P 500, that's indexed to the S&P 500 through Vanguard. If I'm going to go buy another ETF at BMO, and I also want to buy one that's tracking the S&P 500, you're basically investing in the same thing, because those companies that are the underlying assets are the exact same 500 companies. So it's the S&P 500, the top 500 companies in the US. So whether you're buying it from BMO or you're buying it from Vanguard, the underlying assets are the same. Now, other factors may come into place, like the fees, you understand, or the price at the time, whatever that looks like. But make sure you don't find yourself, because if you're picking, you know, several ETFs, you might find yourself investing in the same companies over and over and over again, and you're just duplicating effort unnecessarily. Okay. So make sure to understand what it is you're putting your money into. Um, Okay, so we are close to time. I just have one more section. Actually, I'll talk about it. Okay, so let's talk about ETFs to check out. So these are just some ETFs um that they're quite popular. A lot of people, if you are already into ETF investing, you would have heard of some of them. But because of time, I may not go into too much detail, but I will go. Let me talk about the first two, and then we'll wrap it up. Okay, so VCN, VTI. So these are two uh Vanguard. So I'm talking about Vanguard. Vanguard is like the most popular. They're also some of the lowest when it comes to fees, and they're just so easy to understand. They've been in this business. I mean, they literally were the ones that started index investing. You understand? So they're so good at this. Okay. So I'm using them as an example just because I have no personal affiliation with Vanguard. They don't pay me to do this. This is just because they're easy to understand, and they get it. So first two, or not two, they're not okay. Let's just go right into it. VCN, VTI. So they are two ETFs that track the total stock market, for example. So there's total stock market ETFs. So VCN, for example, is the total Canadian stock market. VTI, total US stock market. So if you're like me and you want to be lazy, you don't want to overthink, you just want to put your money into something that you know, okay, it's doing everything that it's doing. These are two you can check out. So VCN, it invests in everything on the Toronto Stock Exchange, like the Canadian stock market, the entire Canadian stock market, large cap, mid cap, small cap, whatever cap, puts it all in there. So, your portfolio will be very much diversified. VTI, total US stock market. Okay. Another pair that you can check out is VFV VOO. So VFV, for example, tracks the S&P 500. It's in Canadian dollars. VOO is the exact same thing. It tracks the top 500 company, the S&P 500 index, which tracks the top 500 companies in the US, but it's in US dollars. Okay, so if you're buying VFV and you're buying VOO, just kind of like I talked about, you're buying the exact same thing. It's just one is Canadian dollars, one is US dollars. Okay, so it's very simple, very easy to understand. And invest in the top 500. It's 504 companies, not actually 500. US companies in companies in the United States. Okay, so your tech, banking, manufacturing, whatever the companies are that make up the 504 top US companies, that's exactly what it's investing. Okay, so VFE, VOO, those are another two you can check out. So the first two we mentioned are VC and VTI. So VTI is total US stock market, VCN total Canadian stock market. Okay. The next set I did mention I only do two, but because of time, let me just wrap it up with these two and then we can close. So VXC, VT. So VXC is, for example, it tracks all the companies international markets except Canadian companies. Okay. So for example, you can combine say VCN and VXC, right? So you would have, okay, VCN has all your Canadian companies, VXC has all your other international companies, including the US, Japan, European Union, whatnot, except Canadian companies. So those two, for example, make a really good sandwich. Okay. Those two combined make a really nice ETF sandwich. Okay. So that's just an example of how you can combine ETFs and, your portfolio is already diversified if you invest in an ETF, but how you can further make sure that you're touching everything if you want to use ETF investing. Okay. VT is another one. So VT is heavy on is international exposure, same thing, but excluding US companies. So if you're someone, you already have, for example, say VFV, you can combine VFV with VT, for example. Okay. Now, depending on your currency and whatnot, this is not financial advice. This is just, an example. So please talk to your financial advisor and go from there. Thank you all so much for joining us. Have a wonderful rest of your day, and we will see you next week. Remember, I go live every Saturday at 12 p.m. Eastern. Thank you for joining. Hope you learned something. If you did, leave a comment, leave a like, and of course, help us share and send the word. Okay? Thank you all for joining. Have a wonderful, wonderful, wonderful day. Bye.